Right, so you want to understand this ARK Venture Fund, huh? Well, you've come to the right place. You've given us a bunch of documents to dig through the prospectus, some financial highlights and some pretty deep descriptions of their investment strategy.
Yeah, and the prospectus is dated November 27, 2024, so this stuff's pretty fresh.
That's great. We always love working with the latest info. So right off the bat, it looks like this is structured as an interval fund.
Right.
Can you explain what that means for our listener who might not be familiar with that term?
An interval fund is a type of closed-end fund, but it doesn't trade on the regular stock exchanges.
So what does that mean for someone who invests in it?
It means you can only sell your shares back to the fund at very specific times.
Oh, okay.
In this case, they offer to buy shares back quarterly.
Okay, so there's less flexibility compared to owning a regular stock that you could trade anytime you want.
Exactly. You can't just catch out whenever you feel like it. And on top of that, the prospectus says they'll likely stick to repurchasing the minimum 5% of outstanding shares each quarter. And those repurchases could be oversubscribed, which means that some investors who want to sell might not be able to.
So that's something to consider right off the bat.
Absolutely.
It's not the most liquid investment.
Not at all.
So let's talk about the fund itself, this ARK Venture Fund, or ARKVX as it's known. What is it trying to achieve?
Well, their main goal is long-term capital growth, and the way they want to do this is by investing in what they call disruptive innovation.
Disruptive innovation. Huh. That sounds pretty exciting. What exactly do they mean by that?
Well, they're basically targeting technologies that they believe have the potential to reshape whole industries or even the world.
So they're looking for those big game-changing ideas.
Yeah. Extending the human lifespan.
Wow, okay.
Automation transforming how industries operate,
Yeah.
and the next generation of the internet.
All right, so we're talking about some seriously futuristic stuff here.
Oh, yeah.
Let's get down to the nitty-gritty for a minute. What are some of the key numbers our listeners should be aware of?
All right. Well, first of all, there's no sales load for this fund.
That's good to know.
And the minimum you generally need to invest is $500.
Okay.
But for some investors, it can even be lower.
All right, so it's accessible to a range of investors.
Yeah.
But what about fees? What are the costs involved here?
Okay. The big one is the management fee. That's a 2.75% annual rate.
Okay.
And it's calculated on the average daily value of the fund's assets.
All right, so that's something to keep in mind. And are there any other fees?
There's also a service fee of 0.15% for shareholder services.
Gotcha. So those are ongoing costs to be aware of. Now let's talk about risk. Every investment comes with risk.
Yeah.
But what are some of the key ones associated with this fund?
Well, the prospectus is very clear that investing in this fund comes with significant risks.
Significant. Okay, so no sugarcoating it?
No, they're very upfront about it. One of the most prominent risks is something they call disruptive innovation risk.
Disruptive innovation risk. Okay, that sounds a little counterintuitive.
Right.
What do they mean by that?
It basically means that the companies they invest in might not actually be successful in changing the world as they predict.
Ah, I see.
The technologies might not catch on. They might face unexpected challenges, or the market just might not respond the way they expect.
So even though they're targeting game-changing companies, there's no guarantee those companies will actually, disrupt anything.
Exactly. And then there's concentration risk. This fund is heavily focused on the technology sector.
Right.
So if that sector takes a downturn, the whole fund could be hit hard.
It's like putting all your eggs in one very tech-focused basket.
Yeah, and if technology stumbles, the whole basket could fall.
All right, so concentration risk is a big one. Are there any other risks our listeners should be aware of?
Another important one is what they call repurchase program risk. Remember we talked about how you can only sell your shares back to the fund at certain times?
Right.
Even with those quarterly repurchase offers, there's a chance you might not be able to sell your shares when you want.
That's not ideal.
No, especially if you need to access your money quickly.
So liquidity is definitely something to keep in mind with this investment.
Absolutely.
And is there anything else that stands out in terms of risk?
Well, they also mentioned that the fund may invest in cryptocurrencies indirectly.
Crypto.
Yes. And those, as we know, come with their own set of risks.
As putting it mildly, crypto can be a wild ride.
It certainly can.
So that's an added layer of risks to think about.
Yeah.
All right, so we've got these key risks: disruptive innovation, risk, concentration risk, and repurchase program risk, plus the whole crypto thing.
Right.
Now, what about the outlook for this fund? What can investors expect going forward?
Well, the prospectus doesn't make any specific predictions about future performance.
Of course.
Yeah.
It's not a crystal ball.
Exactly. But given the innovative nature of the companies they're targeting, this could be a very high-growth venture.
That's exciting. But high growth often comes with high risk, right?
Absolutely. It's
Mm.
likely to be a volatile ride.
So this is not for someone looking for a slow and steady investment.
No, it's more for someone who has a long-term mindset and can stomach some ups and downs.
All right, so we've got the big picture. Now let's get into the specifics. What are the actual investment themes that ARK is focusing on?
They've identified 6 key areas where they see the greatest potential for disruptive innovation.
6. Okay, lay them on me.
We've got genomic revolution companies, automation transformation companies, energy transformation companies, artificial intelligence companies, next-generation internet companies, and fintech innovation companies.
That's quite a list.
Each of these themes represents a powerful force for change in the world.
It sounds like they've really thought this through. So they're not just picking companies randomly. They've got a clear strategy.
Exactly.
Let's break these themes down one by one, starting with the first one, genomic revolution companies. What's that all about?
It's all about using genomics to improve human and other life. Think gene editing, personalized medicine, even agricultural biotechnology.
Wow. That's pretty mind-blowing.
It is.
This is like straight out of a science fiction novel, but it's actually happening now.
It is.
And ARK is investing in the companies leading the charge.
That's right.
All right, so genomics, that's the first one. What about automation transformation companies? What are they up to?
Well, they're all about using robotics, autonomous vehicles, and artificial intelligence to automate tasks across different industries.
So boosting productivity and efficiency.
Exactly, transforming the way we work.
Okay, so robots are going to be doing a lot of the heavy lifting in the future.
It seems that way.
Both exciting and a little scary. All right, what's next on the list?
Energy transformation companies.
Okay, energy transformation. What's happening in that space?
They're focused on finding new and innovative ways to power our world.
So things like renewable energy.
Yeah, improving energy storage.
Yeah.
And just making energy systems more sustainable and efficient overall.
That's definitely a hot topic these days, given the concerns about climate change.
Absolutely.
All right, next up we have artificial intelligence, or AI. Everyone's talking about AI these days. What's ARK's take on it?
They're looking at companies that are developing and applying AI across a whole range of sectors.
So like machine learning, natural language processing.
Yep. Computer vision, robotics, all that good stuff.
They're covering all the bases, so they're betting on AI to really transform the world.
That's the idea.
Okay, AI check. What about the next generation internet? What does that even mean in 2024?
Well, think about the evolution of the internet as we know it.
Okay.
We're talking about the shift to cloud computing, the rise of the metaverse, and the growing interconnectedness of devices and systems.
So it's not just about faster internet speeds. It's
Yeah.
about a whole new way of experiencing the digital world.
Exactly. More immersive and interactive.
All right, that's pretty fascinating.
Yeah.
Finally, let's talk about fintech innovation companies. What are they doing in the world of finance and technology?
Fintech is all about using technology to improve and disrupt traditional financial services.
Okay.
So we're talking mobile payments, blockchain, cryptocurrency, peer-to-peer lending robo-advisors.
So they're shaking things up in the financial sector.
Trying to.
It's all about making financial services more accessible, efficient, and user-friendly. So those are the 6 big investment themes that ARK is focusing on. It's all very tech-heavy. I'm curious, with all this emphasis on technology, where do ESG considerations fit in? Are they factoring in environmental, social, and governance issues in their decision-making?
That's a great question. While they do say they integrate ESG considerations into their research process, they don't use ESG factors to exclude any specific companies or sectors.
So it seems like their primary focus is really on the potential for disruptive innovation.
Yes, that seems to be their main driver.
Okay, so before we wrap up this part of our deep dive, let's come back to those risks for a moment.
Okay.
It's important to remember that this is a high-risk, high-reward investment.
Very much so.
The potential for big returns is there, but so is the potential for losses.
Right.
So let's dig a little deeper into some of the specific risks outlined in the prospectus. What are some of the key ones that really stand out to you?
All right. Well, we already talked about disruptive innovation risk and concentration risk.
Right.
But there are a few others that are worth exploring in a bit more detail.
Okay. Let's hear it. What else should our listener be aware of?
Well, one that jumps out is market risk.
Market risk. What do they mean by that?
This is the risk that the value of the fund's assets will fluctuate along with the overall market.
Okay. So that's just like any investment, right? The value can go up and down.
Right. It's a basic principle of investing, but it's particularly relevant here given the fund's focus on a volatile sector like technology.
So even if the companies they're investing in are doing well, external market forces could impact the fund's performance.
Exactly. And the prospectus goes on to highlight some specific things that could impact the market.
Like what?
Well, they mention things like inflation changes in interest rates.
Yeah, those can definitely shake things up.
And they even bring up the possibility of some significant global events.
Oh boy, like what?
Things like wars, acts of terrorism, or even pandemics.
So it's not just about market fluctuations, it's about global events that could really throw a wrench in the works.
Exactly. These are all factors that are outside of the fund's control.
Okay, so market risk, that's a big one. What else is on your list?
Another important one is non-diversification risk.
Non-diversification risk. Remind me what that means again?
Remember, this fund is classified as non-diversified, which basically means that they can invest a larger portion of their assets in a smaller number of issuers.
Okay, so they're not spreading their bets as widely as some other funds might.
Exactly. They're concentrating their investments in a more select group of companies.
And what's the risk with that?
Well, as the prospectus points out, this concentration could magnify gains, but it could also magnify losses.
Ah, I see. So if one of their big bets goes south, it could really drag the whole fund down.
Exactly. And they also highlight the fact that this lack of diversification could make the fund more volatile.
Meaning the price could swing up or down more dramatically than a more diversified fund.
Right.
Okay. So non-diversification risk, definitely something to be aware of. What else should we be thinking about?
Let's talk about communications sector risk.
Communication sector risk.
The prospectus acknowledges that the fund will be more affected by the performance of the communication sector than a fund with less exposure to that sector.
Well, that makes sense given their focus on disruptive innovation.
Right. A lot of those innovative companies are going to be in the communications sector.
Exactly. So what are the specific risks associated with that sector?
Well, they mention the rapid pace of technological advancement and innovation, which could lead to products and services becoming obsolete very quickly.
So today's hot new gadget could be tomorrow's old news.
Exactly. And they also mention intense competition pricing pressures and unpredictable changes in consumer tastes.
So it's a very dynamic and competitive sector.
Very much so.
Not exactly a safe haven for investors.
Not really. And they also bring up the issue of network security breaches.
Cybersecurity.
Yes. While all companies are vulnerable to cyber attacks, they suggest that companies in the communications sector might be particularly targeted.
That's a good point. We hear about data breaches and cyber attacks all the time.
All the time.
And if a company experiences a major security breach, it could really damage their business.
Absolutely. And that could trickle down to the fund's performance.
Okay, so communications sector risk, another one to keep in mind. What else is there?
Well, we talked about this before, but it's worth reiterating. The fact that this fund might invest in Bitcoin, Ether, or other cryptocurrencies indirectly.
Cryptocurrencies. And that adds another layer of risk.
Definitely. The crypto market is notoriously volatile.
It is.
So investors need to be prepared for some potentially wild price swings.
Absolutely.
Okay, so we've got market risk, non-diversification, risk, communications sector risk, and the added wrinkle of crypto. What else is on the risk radar?
Another big one is valuation risk.
Valuation risk. What's that all about?
Well, a lot of the fund's investments are in private companies.
Right.
And it can be really difficult to accurately assess the true value of those companies.
Yeah, private companies don't have the same public financial reporting requirements as publicly traded companies, so it's a bit more of a black box. Exactly. And that uncertainty around valuations adds another layer of risk for investors.
Because it's hard to know for sure what those companies are actually worth.
Right.
Okay, valuation risk. Got it. What else?
They also mention currency risk, which is the risk that changes in currency exchange rates could impact the value of the fund's investments in foreign securities.
Ah, yes, currency risk. That's something to think about, especially given the global nature of their investment strategy.
Absolutely. Exchange rates can fluctuate a lot, and that can really eat into your returns.
It's like another layer of volatility on top of everything else.
Right.
Right. Currency risk noted. What else?
Well, they also touch on cybersecurity risk, which we already talked about in the context of the communications sector.
Right.
But they point out that it's a risk for the fund as a whole as well as for individual companies.
So cybersecurity is like an overarching risk that touches every aspect of the fund's operations.
Exactly. It's something they have to be constantly vigilant about.
All right, so it sounds like they've really covered a lot of potential risks here. Is there anything else we should be thinking about?
They do list a number of other risks in the prospectus, but I think we've covered the most important ones for our listeners today.
Okay. So we've explored the fund's summary, had a look at the financials, dove into the risks and fees, and talked about the general outlook. It's a lot to process.
It is.
But don't worry, we'll be back next week for part 2 of this deep dive,
That's right.
where we'll explore those risks a bit more and see how they might play out in different market scenarios.
Exactly. It's not just about understanding the risks, but also thinking about how they might impact your investment in different conditions.
And as always, a reminder that this is just a deep dive into the information you provided, and it shouldn't be taken as investment advice. You should always do your own research and talk to a financial professional before making any investment decisions. Welcome back. Last time we were really digging into the ARK Venture Fund, this ARKVX. We talked about their goals and fees and got a good overview of the risks involved. But I think it's time to unpack those risks a bit further. What do you think?
I agree. Understanding the risk is super important, especially with an investment like this one.
Right. It's one thing to read about them in the prospectus,
Yeah,
but it's another thing to really understand how they could play out in the real world.
exactly.
So we talked about market risk last time, which basically means the fund's value can go up and down with the overall market. But the prospectus actually goes a little deeper than that.
Right. They highlight some specific things that could cause those market fluctuations, like unexpected inflation, shifts in interest rates, even those global events we talked about, like wars or pandemics.
It's a lot to think about.
It is. There are a lot of factors that can impact market performance, and those factors are largely outside of the fund's control.
Okay, so market risk is definitely something to keep in mind. Let's move on to another risk we touched on last time, non-diversification risk.
Okay.
This is the one where they can put a bigger chunk of their assets into a smaller group of companies.
Yeah, that's right.
It's a more focused approach.
Higher potential rewards, but also potentially higher losses if those companies don't perform well.
Exactly. And the prospectus is very clear about that. They say that this concentration can make the fund more volatile.
Meaning the price could swing up or down more dramatically.
Exactly. Compared to a more diversified fund.
So it's not for someone looking for a smooth, predictable ride.
No. This is more for someone who's comfortable with some ups and downs.
Got it. So non-diversification risk is something to consider carefully. Now let's talk about the communications sector risk. This one's particularly interesting to me because it seems like so many of these companies that are driving disruptive innovation are in this sector.
That's true. The communications sector is a hotbed of innovation.
So what are some of the specific risks tied to that sector? Well, the prospectus talks about the rapid pace of technological change, which means that products and services can become obsolete very quickly.
So what's cutting edge today could be outdated tomorrow.
Exactly. And then there's also intense competition, pricing pressures, and the fact that consumer tastes can change very unpredictably.
It sounds like a tough environment to operate in.
It is. It's a very dynamic and competitive sector.
And they also mentioned something that's very relevant these days, cybersecurity breaches.
Right. Cybersecurity is a major concern for any company, but especially in the tech world.
And it seems like companies in the communications sector might be even more vulnerable to these kinds of attacks.
That's what the prospectus suggests. They often hold a lot of valuable data, and they're constantly pushing the boundaries of technology, which can sometimes make them more susceptible to breaches.
Right. And a major data breach can really damage a company's reputation and its bottom line.
Absolutely. And that damage can ultimately impact the fund's performance.
Okay, so communication sector risk, another one to keep in mind. Now let's talk about something that might surprise some people, cryptocurrency.
Right.
The prospectus mentions that the fund may invest in Bitcoin, Ether, or other cryptocurrencies indirectly.
Yes, they do.
Which is interesting, because cryptocurrency is known for being very volatile.
It's one of the most volatile asset classes out there.
So that adds a whole other layer of risk to this fund.
It does. Investors need to be prepared for the possibility of significant price swings.
Crypto is definitely not for the faint of heart.
No. It's a high-risk, high-reward game.
Okay, so we've got market risk, non-diversification risk, communications sector risk, and now the added element of cryptocurrency. What else are we looking at?
Another important risk they highlight is valuation risk.
Valuation risk, right.
This is particularly relevant for this fund because a lot of their investments are in private companies.
Which can be harder to value than public companies.
Exactly, because they don't have the same public financial reporting requirements, so it can be tricky to determine their true value.
So there's more uncertainty involved.
There is, and that uncertainty translates into risk for investors.
Okay, so valuation risk is something to be aware of. What else should we be thinking about?
They also mention currency risk.
Currency risk? Remind me what that is again.
This is the risk that changes in currency exchange rates could impact the value of the fund's investments.
Right, because they're investing in companies all over the world.
Exactly. So if the value of the dollar fluctuates relative to other currencies, it can affect the returns on those investments.
It adds another layer of complexity to the whole thing.
It does. And it's something investors need to be aware of, especially with a globally focused fund like this one.
All right, so currency risk noted. What else is on the list?
Well, they also talk about a risk that's specific to certain foreign holdings called depository receipts risk.
Depository receipts risk. Okay.
Yeah.
I'm not familiar with that one. Can you explain what that is?
Sure. So depository receipts are basically like claim tickets for shares in a foreign company. They trade on U.S. exchanges, but they represent ownership in a company that's based overseas.
Okay.
And the risk here is that these receipts can be less liquid than the underlying shares, and they can also be affected by events in the foreign market where the company is based.
So you're exposed to the risks of the foreign company plus the added risks of these receipts.
Exactly. It's like a double whammy of potential risk.
All right, so depository receipts risk, that's a new one for me. What else should we be thinking about in terms of risks?
They also point out that the fund invests in some companies that may not be currently generating substantial revenue from genomic-focused businesses.
So it's a bet on their future potential.
Exactly. They call this future expected genomic business risk because there's no guarantee that these companies will be successful in developing and commercializing genomic products or services.
It's a riskier bet.
It is, but it also has the potential for higher rewards if those companies do succeed.
Okay. So that's something to keep in mind. Now, aside from the risks associated with foreign investments, are there any other sector-specific risks we should be aware of?
They do highlight a few others, like pharmaceutical company risk.
Pharmaceutical companies.
Yeah.
They're always in the news. What are the risks there?
Well, the prospectus talks about how developing and getting approval for new drugs is a long, expensive, and often unpredictable process.
I can imagine.
And there's always the risk of lawsuits or regulatory changes that could impact a company's profitability.
So even in a cutting-edge industry like pharmaceuticals, there are inherent risks involved.
Absolutely.
What other sector-specific risks should we consider?
They also mention financial technology risk, or fintech risk, as it's often called.
Fintech, yeah, that's a booming industry. What are the risks there?
Well, they point out that fintech companies often face intense competition from much larger, well-established financial institutions.
That makes sense. The big banks have a lot of resources.
They do. And they also highlight the risk that a fintech company's technology could become obsolete.
Which is always a possibility in the fast-paced world of technology.
Exactly. And then, of course, there's internet company risk.
Internet companies.
Right.
They face their own unique set of challenges.
They do things like competition, data security, and the constantly evolving landscape of the internet itself.
It's a tough business to be in.
It is.
So it seems like we've covered a lot of risks here. And I'm noticing a bit of a theme.
What do you mean?
Well, it seems like a lot of these risks are really intertwined with the fund's core focus, disruptive innovation.
That's a great point.
The very nature of investing in companies that are trying to change the world inherently comes with a lot of uncertainty and risk.
Absolutely. That's why it's so important to carefully consider your own risk tolerance before investing in a fund like this.
It's definitely not for everyone.
No, it's not.
Okay. Well, I think our listener has a pretty good understanding of the risks involved now. But I'm curious, how might these risks actually play out in different market conditions? That's what I really want to explore next.
That's a great question. And I think it's crucial to consider what happens if interest rates rise, or if we enter a period of economic slowdown. How might those scenarios affect the fund's performance?
Those are great questions. I'm ready to dive into that.
Well, you too.
Join us next time for part 3, where we'll put these risks into perspective and see how they might play out in the real world. Welcome back to our deep dive. It's time for the final part of our look at the ARK Venture Fund, ARKVX. We've covered a lot of ground talking about their investment approach to those fees and, of course, all those risks they lay out in the prospectus.
We have, and hopefully our listeners have a good grasp of what those risks are.
Yeah. But now comes the really interesting part. What do those risks look like in action? How could they actually play out in different economic conditions?
That's the key, isn't it?
Yeah.
Understanding those risks in theory is one thing, but thinking about how they could impact you as an investor in real-world scenarios, that's essential.
Exactly. So let's start with something that everyone seems to be talking about lately, rising interest rates.
Okay.
What happens to a fund like this one if interest rates start climbing?
Well, it could create some challenges, especially for a fund that's heavily invested in growth companies like this one.
Why is that? Why are rising interest rates bad news for companies that are focused on growth?
Think about it this way. Higher interest rates make it more expensive for companies to borrow money.
Right.
And a lot of these young companies, especially in the tech sector, they need to borrow money to fuel their growth.
If they can't borrow money as easily or as cheaply, their expansion plans could be slowed down.
Exactly. And it also makes those future earnings less valuable in today's dollars. That's how investors think about it.
So even if a company has a lot of potential, those high interest rates make that potential less attractive to investors in the short term.
Precisely. And remember, this fund invests in a lot of young, early-stage companies. Those companies often need a lot of funding to develop their technologies and grow their businesses.
And if that funding dries up because interest rates are too high, their growth could really stall.
Right. They might not be able to achieve their full potential.
Which would then impact the fund's performance. Okay, so rising interest rates are something investors should definitely keep an eye on. Now, what about the opposite scenario? What if the economy slows down? We're talking about a global recession or a period of economic uncertainty.
Well, in those kinds of situations, people tend to be more cautious with their spending.
That makes sense.
They focus on essentials. And that means less money flowing to those innovative, sometimes non-essential products and services.
Even if those products or services are revolutionary.
Even then, the truth is that disruptive innovation doesn't always do well in a weak economy.
So a fund like ARKVX that's so focused on these potentially game-changing companies could actually struggle during a downturn because people just aren't spending as much.
That's a real possibility. Consumer behavior plays a big role here. And when the economy slows down, people change their spending habits.
Okay, so economic slowdown, another thing to consider. What about inflation? We've seen prices rising for a lot of goods and services lately. How does inflation affect a fund like this one?
Inflation is a big concern for any investor because it basically erodes the purchasing power of your money over time.
Right. If prices are going up faster than your investments are growing, you're actually losing money.
Exactly. And remember, this fund is really betting on future growth. But if those future earnings are worth less in today's dollars because of inflation, it can really impact the overall return.
It's a sneaky way to lose money.
It is. It's something that all investors need to be aware of.
Okay, so we've got rising interest rates, economic slowdown, inflation, and then, of course, there are always those geopolitical events that can really throw a wrench in the works.
Oh, yeah. Those are the wild cards. Wars, political instability, pandemics. You never know what's going to happen.
And those events can have a big impact on the global economy.
Absolutely. They can create a lot of uncertainty and volatility.
Which is not what you want when you're trying to grow your investments.
Right. These kinds of events can disrupt even the most well-constructed portfolio.
So even if the companies in the fund are performing well, a sudden global event could really change things.
That's the risk you take when you invest in the stock market. There are no guarantees.
And it seems like those risks are amplified when you're dealing with a fund that's so focused on innovation.
I think that's a fair assessment. The companies that are trying to change the world often face more uncertainty and volatility than more established companies.
Well, I think we've given our listener a lot to think about today.
I hope so.
We've explored the ARK Venture Fund's investment strategy. We've dug into the fees. We've really dissected those risks. And we've even talked about how those risks could play out in different economic scenarios.
We've covered a lot of ground.
We have. So as we wrap up this deep dive, what's the key takeaway for our listener? What should they be thinking about as they consider this fund?
I think the main takeaway is that this fund has the potential for high returns, but it also comes with a lot of risk. It's not for everyone.
It's for someone who understands those risks, has a long-term perspective, and is comfortable with the ups and downs that come with investing in innovative companies.
Exactly. And they should also remember that this is just our analysis based on the information we were given. It's not a substitute for doing their own research and talking to a financial advisor.
That's right. We've tried to give you a good overview of this fund, but ultimately the decision of whether or not to invest is up to you.
And you should always consult with a professional before making any financial decisions.
Well said. All right, that's it for our deep dive into the ARK Venture Fund. Thanks for joining us.